Okay, we're going to go live here, 12 o'clock or 12:03. Welcome everyone to our webinar for board certification with some tax tips. I'm going to briefly introduce everyone and then everyone can introduce themselves, all the panel speakers and sponsors. My name is Peggy West. I'm with Puro Clean. We are 24/7 responding to water, fire, mold, and damage and restoration or removal. And we have been in business for 30 years. We have about 330 offices nationally, 26 in Florida. So we're here ready to help you if you have any damages that we can help you with. I want to say that I really appreciate everyone being on the call today, the webinar today. And if you have any questions, please go onto your chat button, enter your question, and we will field the questions throughout the entire seminar. With that, I'm going to introduce Jonathan Doro. He is with Vinteum Software, who is the coordinator of all of the webinar functions and the technical part of the presentation. On the call, you will also meet Nicole Johnson Pendergrass, if you want to wave a little bit, and William, we call him Bill Kilgallen. He's our tax principal today, and the course is spearheaded by Scott Wortman, Esquire of SJW Law Group. So with that, I'm going to turn it over to Jonathan. You want to do your introduction?
Yeah, I'd love to. Thank you very much, Peggy, and thank you everybody for attending. These are periodically put together and thank you very much for your attendance. Looking forward to a fantastic webinar. I work with Vinteum Software. I'm the managing director there, and what Vinteum does is provide community associations, whether that be an HOA, condo, or even their management company, with a front-end facing website and a back-end secure portal to access things like community documents, reserve different amenities, whether it be the pool, which might be at limited capacity, or the clubhouse or tennis courts. In addition, we also offer, package delivery. We offer a ton of features around communication, such as, email, SMS, voice, automated messages. So you put together a paragraph of text, we convert it into an audio file. It'll actually call residents on their landline, their cell phone, their office line, that sort of stuff. So in addition to communication, we have a lot of social functions. Residents can message one another. We've got a social network or a forum where folks could go ahead and comment on all sorts of different stuff. If anybody has any questions, feel free to shoot me a quick chat, either here or via email. So thank you very much, Peggy. Oh, wait, we've got you muted. No, still muted. There we go.
Okay, all right. So thank you so much, Jonathan. Jonathan does a lot behind the scenes to make this thing work successfully, and I want to thank you again. With that, I'm going to let Nicole and Bill introduce yourselves with Hafer.
I'm Nicole Johnson, Pendergrass with Hafer Company CPAs. And just so everybody knows, me and Bill have been quarantined for 6 months. So we are social distancing, but we have been in the same area for a while. So I don't want anything, we're not social distancing. I am a partner with the firm. We concentrate in the area of CIRAs, Common Interest Building Associations. We do audits, reviews, compilations. We do year-end reporting. We assist with any type of budgeting. This year's been probably the busiest year that we've had, with a lot of consulting work regarding people going through COVID, financially, what they should be doing, reserves, what they're allowed to do, tax situation, PPP money.
Yeah,
I'll turn it over to Bill.
PPP loans, yes. So, yeah, I am Bill Kilgallen, and I'm a principal here on the tax side. Do not only tax, but some consulting as well. And I enjoy my days here with Nicole. We've been stuck together now for like 6 months.
6 months.
Very good. Well, I'm glad we have the dynamic duo back again here. So now I'm going to turn this over to a longtime professional friend of mine, Scott J. Wortman, Esquire, who's going to do the board certification, and also want you all to know he is a Condo and Homeowner Association attorney primarily. So he has a lot of information. And again, feel free to put your questions on the chat, or we can answer them following. Or if you want to get the information on how to get a hold of Scott or Nicole or Bill, please send me an email and I'll get it out to them. With that, Scott?
Thanks, Peggy. And thanks everyone for joining. Thanks to our sponsors, Peggy for setting us up, and Jonathan for doing all the technical stuff behind the scenes, and of course, Nicole and Bill for joining us today and being a big part of the seminar. We're gonna have a lot of great information. Briefly about myself, I'm an attorney licensed in the state of Florida, practicing 26 plus years. I'm Florida Bar Board certified in the areas of real estate law and Florida Bar Board certified in the areas of condominium and planned development law. I represent my firm, approximately 80 communities throughout the state of Florida, handling all their governance related issues, covenant enforcement, collections, modifying their documents, answering questions as they arise, dealing with litigation. So everything imaginable as it relates to condominium and homeowners associations. My office is in Wellington, and I'm happy to do this presentation for you guys today. I've done this many times, particularly with Nicole and Bill and with Peggy. And we like to, although it's obviously unique because we're not face to face, unfortunately, because of obvious circumstances, to the extent that we can, we want to try and keep it informal by way of you throwing questions our way, which Jonathan is going to capture and politely interrupt us and fire questions at us as we talk about a variety of topics. It's very noble of you to sit for these board certification classes. It's a great way to get lots of good information. Unfortunately, 2 hours can't really cover every area of homeowners association law, condominium association law, and co-ops. The amount of information, the statutes, the procedures, the practice points, the tips are so extensive, it's impossible, obviously, to cover it in 2 hours. But we're going to try and highlight some topics that frequently come up. And if you need to follow up with us either in the course of this webinar or thereafter, please reach out to us. Specifically, my email, which I believe has been provided, but just once again, is Scott, S-C-O-T-T, at S as in Sam, J as in Jack, W as in William, lawgroup.com. That's Scott at sjwlawgroup.com. My phone number also is 561-340-4555. Okay, enough of the preliminaries. I'm sure you're ready to dive into the substance. So the first topic I'm going to hit is just some basics as it relates to how to run a board of directors meeting. I regularly attend board of directors meetings, and it's rare that you see a community conduct a board of directors meeting similarly. They all kind of have their own little nuances, but there's some rules of the road you definitely have to abide by. Most governing documents have some boilerplate language which provide structure and parameters how to run a board meeting, but more importantly, Florida's Homeowners Association Act, Florida's Condominium Association Act also provides guidance as to how these board of directors meetings are supposed to be run. Here are a few tips, or important points rather. First, it starts with the president, and most of the time, in most communities, the president runs the board meeting properly. In other cases, you may have some other individuals on a board who take more of a leadership role, and they tend to direct the board meeting. Typically and technically, the board of directors meeting must be run by the president. The president's primary role on the board of directors is not to make all the decisions for the community. You know, sometimes that does happen that way. The president's role is to conduct the board of directors meeting. If the president is not present at a board of directors meeting, then it defaults to the vice president. It's not up for grabs as to who runs the board of directors meeting. It's not for the property manager to run the board of directors meeting, although property managers can be helpful and could provide a guide for purposes of running through the agenda. But technically is for the president to run. In the president's absence, the vice president steps in.
And Scott, along those lines, we've got some questions coming in. One is, how are the powers of, or sorry, what are the powers of the president of the HOA?
Yeah, and the powers of the president really are no different than any other member of the board of directors. The president has one vote on the board of directors, just like every other member. Oftentimes, you do see the president take a significant leadership role and sometimes make the decisions all by themselves as it relates to certain critical issues in a community. It's not appropriate. A president, while it's perfectly fine to take the lead and to guide the discussion and to orchestrate perhaps a certain policy, the ultimate implementation of the idea, the policy, the decision rests with the board of directors as a collective, not with one single member of the board of directors. So while it's typical that the president of each board tends to exert a significant more amount of authority and in theory than other members of board of directors, their authority is exactly equal to each and every other member of the board of directors. It's one single vote. As it relates to a board of directors meeting, what is a board of directors meeting? When do you have a board of directors meeting? And this comes up frequently. When you have a quorum of the board, let's take an example. You have 5 individuals on a board of directors. You have 3 of 5 that are getting together to discuss association business. That is a board of directors meeting. Whether or not it's taking place in the clubhouse, whether or not that's taking place in a formal room designated by the board, or whether or not it's at a coffee shop. Well, not too many coffee shops open these days, but if you have 3 people in this hypothetical out of the 5-member board of directors who are getting together in someone's house, on the sidewalk, etc., and they're there and they're discussing association business, that amounts to a board of directors meeting. What does that trigger? That would have triggered a notice obligation to the membership. The membership has a right to view and witness the deliberations of the board of directors. While there's no technical open sunshine law as it relates to associations, the principle of open sunshine laws, which pertains to governmental agencies, applies in the homeowners association and condominium association and co-op context. Throughout this discussion, I'm probably going to exclude the term co-ops. Just so you know, I'm including that when I say HOAs and condos. And parenthetically, co-ops have virtually the exact same of statutory requirements as condominium associations. So if members of the board of directors, a quorum, a majority, get together to discuss association business, there must be a notice sent out to the community, and it's oftentimes a 48-hour notice. That's a typical notice, both in the HOA context and the condo context. 48 hours is required. The notice must be posted in a conspicuous location. There are other types of meetings, which we're going to get to later on in this presentation, which mandate a different type of notice structure, particularly a 14-day notice for certain types of meetings. Annual meetings are a whole different animal. For condos, it's 60 days, and sometimes for HOAs as well. But for your regular board of directors meetings, there's a 48-hour conspicuous notice obligation. So the point of all this is that it is important that the board of directors not secretly get together to discuss association business, because the board could then be accused of not properly noticing board of directors meetings and running afoul of the notice requirements as set forth in the condo and the HOA statute. I've also heard this term thrown around quite a bit, where I've been asked, can we have executive sessions? And does that allow us to kind of close the doors and keep out the membership, because we have some important issues to discuss as a board privately? There is no such thing as an executive session. It's a term of art that is thrown around quite a bit, but it does not exist. There are only 2 very rare exceptions to being able to have a private board of directors meeting among the members of the board of directors. All other discussions even if it involves something like a quote unquote workshop, for example, I've heard that term thrown around quite a bit. Those could be done. There's nothing wrong with doing a workshop. There's nothing wrong with doing an executive session, if that's a label you want to put on the board of directors meeting, but it has to be noticed to the membership. A typical board of directors meeting, again, 48 hours notice. What are the two exceptions to this notice rule? If the board is discussing with the attorney for the association present matters that involve pending or threatened litigation, then those are attorney-client privilege discussions for which you could not invite and should not invite the membership to participate or witness. That could be a closed meeting. Attorney-client privilege discussions involving pending or threatened litigation _ litigation, not just any legal issue at all, unless there's a threat that a particular legal issue could turn into litigation, then fine, you could call it a privilege discussion and you could exclude the membership. So that's exception one. Exception two is if you're discussing, we'll call it sensitive personnel matters involving, saying, the hiring or firing of a particular, say, management company or the landscaper or the handyman or the attorney, hopefully never the attorney, but those type of matters, those can be private in nature where the membership need not be invited. However, there can and still should be a notice of the meeting posted in most circumstances in the condominium association context. The HOA statute is silent as to whether or not you need to post a notice when there is this private meeting, when an attorney is present or you're discussing employee sensitive matters. It's probably good practice to notice it anyway, but you make it clear in the notice that it is the membership is not permitted to attend because it is a closed meeting.
Hey, Scott.
Yes.
Along those lines, how can notice be done, whether that's email, you mentioned posting at a conspicuous location, and what should be included in that notice? Always
have a posting of the notice in a conspicuous location. This is a term you've heard me say about 4 or 5 times already. It just has to go in some place where the membership, the residents pass frequently, whether it's outside the clubhouse, on the door, on a bulletin board, at a security guard, gatehouse. That type of location is pretty much deemed a conspicuous location. Email notification is only permissible when and if a member has specifically provided in writing the right to receive notices electronically. Frequently done in a lot of communities that emails are sent out, hey, there's a board meeting on Thursday at 7 p.m. There's nothing wrong with doing that, but that email notice does not cannot be done in lieu of posting the notice in a conspicuous location. It can be done in addition to. The exception is, as I just noted, if a member has come in and filled out a form saying, I agree to accept all notices of meetings and other notices, formal notice from the association in writing, they sign it in writing, and they're consenting to receive that notice electronically. Rarely do you have 100% of the membership signing this form. You might have a few sporadically here and there, maybe even half. So if you don't have the 100% of the membership signing this particular form, then you have to post it in a conspicuous location anyway. So the good practice and procedure is to simply post it in a conspicuous location. And if it requires a 14-day notice for certain types of meetings or annual meetings, or it's 60 days in other circumstances, those should be mailed out, regular mail. Let me quickly move on because I don't want to monopolize the time. I want you to get the benefit of Nicole and Bill's presentation as well. Generally speaking, there's a practice as it relates to passing motions at a board of directors meeting, which is oftentimes not followed. So this is how it's supposed to flow. Say there's an idea that the board would like to memorialize and adopt formally. At the board of directors meeting, a member makes a motion to do A, B, C, and D. And that is recorded in the meeting minutes. Which particular board member has decided to make this particular motion? Then there's a second of that motion. And some of this might be simplistic for some of you folks that have gone through this several times, but it's worth repeating. Another board director then makes a second. That's also recorded in the meeting minutes. All this needs to be recorded for reasons I'll get to in a second. And then there is a discussion among the board, if there is to be a discussion, to deliberate as to the issue. So if board members want to discuss it and the pros and cons of adopting a certain item, that's when that takes place. Do you then move on to take a vote? No. This is where you have to offer the membership an opportunity to chime in, to say what they want to say about the particular item that is being considered by the board. It makes no sense to have the membership talk about the issue after the board has already voted, because the board is supposed to get the benefit of the commentary from the membership. So you then ask, after the board is done deliberating, are there any individuals here present, whether it's Zoom or in person, depending upon the nature of the board meeting that's going on, would like to comment as it relates to this particular agenda item and motion that is before the board? What you want to do is limit it to 3 minutes. That's common and proper practice and a way to efficiently get through a meeting so it doesn't go on, and then move on to the next person. Another practice tip point is to try to avoid the back and forth with a particular member. Oftentimes these participations, for lack of a better word, devolve into kind of a question and answer session between the member who's raising his or her hand and the board. And while you as a board member, you feel compelled to want to answer the question, and that's a nice thing, but to move the meeting along, you want to state at the outset that you have 3 minutes to state what you would like, then we're going to move on to the next person. We're not really going to go into a question and answer session. But of course, sometimes it turns into that, but in my experience, it's best to try and avoid it as much as possible. Okay. The reason why meeting minutes are important, which seems like a little detail that oftentimes gets overlooked. If a particular decision down the road is challenged by a member saying, you as a board never formally voted to adopt A, B, and C, how do you prove that it was? The meeting minutes. It's not oral testimony, although an affidavit, sure, that could be done in theory if there's litigation, but the highest and best proof that something was done at a meeting are properly recorded meeting minutes, accurately reflecting, like I said, who made the motion, who seconded the motion, the deliberation, the questions that were asked by the member, the vote taken, all in favor, say aye or nay, and that's recorded in the meeting minutes. And this is a business record. Meeting minutes are a business record of the association, subject to inspection by other members, and it's an important document to prove up that a certain decision was made by the board at a certain point in time, which may come into play years from now. So while it may seem ministerial and just another little detail that could easily get overlooked, oftentimes these meeting minutes become the subject of litigation and deposition testimony, and accurately recorded meeting minutes are important.
Scott, when you say that, that's a very good point. So what is your suggestion? We've seen where like minutes are so detailed, where they're like 40 and 50 pages long, and then we see some where they're just recording what was the motion and all that. So what do you recommend in those minutes?
I suggest the latter of the two options that you presented. This is not supposed to be a stenographic recording or recitation of every word that's being uttered by every person. It's to outline the highlights of the actions that occurred and who spoke. The content of the question or the back and forth between the board member and the member should not be written down in meeting minutes. It's too much. So we need not go into that detail. In fact, it leads to the possibility of inaccuracies, misportrayals of what was actually said. So just a general description of who spoke and who voted and who made the particular motions and when. That's my suggestion.
Great advice. Great.
I also like to interject that the minutes are now supposed to be stored for 7 years.
That's right. Thank you, Peggy. Absolutely. there's a whole litany of documents that have to be kept for 7 years, which are called the official records of the association, the business records of the association, which are subject to inspection by a member. And if a document is not properly kept and it cannot be turned over for inspection, the association faces statutory penalties and sometimes lawsuits over failure to allow for the inspection of business records, which is a whole other topic, which I'll try and touch on later. Let me just quickly run through a couple of the other notice requirements for other different types of meetings. The general meeting, as I stated, 48 hours for just a traditional board of directors meeting. For meetings involving the adoption of amendments to your governing documents, it's a 14-day notice. So you want to post that in a conspicuous location, plus, you want to send out a notice, regular mail, along with a copy of the proposed amendment to the declaration to your governing documents. Unless someone has filled out this written consent form to receive notices electronically, then you can send it by email. But it's always good practice just to send it all out regular mail. So 14 days for that purpose. 14 days also for rules and regulations that affect parcel usage. This is a subset of rules and regulations. When a board is looking to adopt a rule, as opposed to a membership-wide vote on an amendment, and that rule is affecting the way someone can use or not use their property, that is called parcel usage, which mandates this 14-day notice requirement, where notice has to go out describing the rules that are sought to be adopted, and if the rules have been memorialized, which is always good practice, that should be included along with the notice and sent out to the membership 14 days in advance.
Hey, Scott, can I ask you a quick question?
Yes.
What about with COVID? What's the board's responsibilities now with COVID?
Yeah, I mean, this is an evolving thing, which I believe at this stage, it's fairly well settled. If Bill, you asked that question back in March or even April, I probably would have a different answer than I do today. Back then I was peppered properly with questions that, do we still need to have a board directors meeting, given what's going on with the pandemic? And back then, the board was within its right, pursuant to its emergency powers, not to have to conduct a meeting that particular month because everything was just up in the air in terms of the pandemic and the health risk. And how we were going to conduct these meetings. I think we're all pretty well used to this Zoom feature by now, and that is the way these board directors meetings are oftentimes being conducted. So to your question, Bill, the status of the health crisis in this country and the state of Florida, regardless of executive orders or not from the governor or from the county where you're located, does not obviate the obligation to conduct a board of directors meeting. You do have the right to say, we're not going to hold it in person for health reasons. You have the right to do that, but you must provide an alternative. And that alternative is either something like what we're doing right now, a Zoom meeting, and that Zoom information, and Bill, that's a good question because it reminds me to remind you guys that the Zoom information, if you're going to conduct your board meetings by Zoom, to include the Zoom information in your notice, the link, the meeting ID password, the meeting ID and the password, so it's easy for folks to see how they could link into the meeting and they could participate in that manner. You could also do a call-in. It doesn't have to be Zoom where your faces are on a screen. Telephone conference with the call-in number is acceptable because that still gives the membership an avenue to participate when appropriate. There's also a practice point in terms of trying to keep an orderly way for folks to be able to ask questions on specific agenda items. You could require in the notice that the membership email the property manager 24 hours in advance if they'd like to speak on a particular agenda item. That way, the property manager at the time of the board of directors meeting will have a list of folks who are interested in speaking on a particular issue. The property manager could just run down the list individual by individual who signed up in advance. That will keep it from being such a disorderly people talking over each other in a Zoom or a telephone conference type setting. As it relates to the notices, and I'm going to wrap up on this, and I'm going to turn a few things over to Nicole and Bill. If you as a board are seeking to impose a special assessment, that also carries a 14-day notice requirement. The notice itself must be real darn specific. It must identify the amount of the special assessment, the gross amount, the amount each unit owner, homeowner is going to be levied in terms of their share of the special assessment, and the purpose of the special assessment. What are you using the monies for? That must be in the notice itself, not to be disclosed for the first time at the board of directors meeting. Otherwise, your notice will be incomplete, and potentially the decision to impose a special assessment will be deemed invalid and unenforceable from a collection standpoint. So that's important. Then we have elections, which for condo associations statutorily, it's quite rigid. 60 days prior to the annual meeting / election, the first notice must go out. Then the notice of intent to be candidate on the board must be delivered to the board 40 days before that meeting. The candidate can then deliver a bio 35 days before the first meeting, all of which will be sent out, the list of candidates and those bios to the extent they're submitted, with the second notice of annual meeting 14 days before the board of directors meeting. So very structured manner in which notices are to be handled in terms of annual meetings and elections from a condominium association perspective. With homeowner associations, although many adopt the condo way of doing it, which is perfectly fine, probably good practice, the HOA statute does not mandate the 60, 40, 35, 14-day calendar of notices and turning in of notice of intent to be candidates. It is a 14-day notice, and only one notice for that matter. But it's also subject how your governing documents read. The condo associations, you are locked into the 60, 40, 35, 14. For HOAs, it's 14 days unless as otherwise set forth in your governing documents. So your declaration will dictate the notices that need to go out in the timeframes for your annual meeting / election. Last point, then I promise I'm going to turn this over to Bill and Nicole. As a board member, I'm oftentimes asked, am I going to be liable for making this decision? Am I going to get sued, for doing A, B, or C? The general answer is almost never, although anyone could sue anyone for any reason. And, I could sue Bill and Nicole because I don't like the color of that credenza behind it. That doesn't mean it's a valid lawsuit, right? So you have frivolous lawsuits that occur. It's all about what is the liability of the particular board member. As a board member, you have a fiduciary obligation to make decisions which are in the best interest of the association. However, there's a heavy level of protection embedded in Florida case law, something called the business judgment rule. The business judgment rule protects all board members from any decision that they're making on behalf of the association, as long as the decision is made in relatively good faith. Meaning that if it's a terrible decision, if it turns out that the decision you as a board member made, as an individual or as a collective board, ended up costing the association quite a bit of money, negligence does not get transmitted onto you as a board member. As long as you made a good faith decision and didn't do it based upon malice or for your own pure self-interest. For instance, you had a conflict of interest. If your brother-in-law owns the landscaping company and the landscaping company ended up suing the association for amounts that they're really not entitled to, and you didn't properly disclose to the membership that your brother-in-law owned the landscaping company, well, we might be having a different discussion. But general decisions, you are safe and secure under the business judgment rule, as well as you should have D&O insurance, directors and officers liability insurance coverage, which would pick up any possible liability as well as attorney fees and costs if in the unlikely event you are sued over a decision made by yourself. Okay, I think I spoke enough for the time being.
Is now with the COVID, the reopening potentially of good within these associations, does that cover those decisions to reopen?
That's a good question. The answer is yes. Again, as long as it's good faith. And I can't imagine a scenario where a judge could say that, or a jury could say that a board member wasn't exercising good faith in shutting down a pool or a playground in today's times. May not be the correct decision based upon the status of the orders coming down from the governor and the particular county, which are ever changing, which is, your council needs to keep up with and advise as to what the governmental order obligations are. But a decision to close down a common area or an amenity would not give rise to liability to an individual board of directors. So with that, we're going to talk a little bit about
that, Bill.
Annual audit obligations, which feeds into what I was just discussing in terms of fiduciary obligation of board members and what associations have to do in terms of annual audits. And I'm going to turn this part over to Nicole and Bill.
Okay, thank you. I do want to reiterate something Scott had brought up so everybody is aware. Whenever you're doing a special assessment or a special assessment meeting, please contact your attorneys and make sure it's done right. We see too many times when we're doing the audits that things aren't done right. They're passing the special assessment with estimates rather than actual numbers, and they're not passing it for. So when he was saying that, please make sure that you talk to your attorneys when you're doing any type of that. Rely on the professionals. So the annual audit obligations, it was a very interesting year this year because the governor actually came in and they extended the deadline. They basically didn't have a deadline. And then he came back, I think it was a day before June 1st, and said that the date was June 1st. So in normal circumstances, the audit is required to be issued to the unit owners for HOAs and condominiums and cooperatives 120 days after year end. So the statute reads 90 days after year end, but to the owners 120 days. So I always tell my associations, as long as it's by April 30th that you have it available, but I do recommend you give that some time. You don't want to be down to the wire April 30th putting out a notice that the audit is available. They're very strict on what those requirements are. And I get a lot of questions this year and every year regarding, what are we required to have? Well, the first thing you need to look at is, what do your documents state? Some associations' documents actually require an audit regardless of the income level. So make sure that there's nothing in your documents. Talk to your attorneys and make sure that there's nothing in there saying that you're required an audit regardless of the income level. Also, making sure your documents don't have a specific deadline. Some of our associations actually say in their documents that the audit has to be issued to the owners by like February 28th or March 1st. So make sure you're reading those documents and getting advice from your attorney if your documents have something specific in there. If not, then you're going to go under what Florida statutes require, 718, 719, and 720. They actually all mirror each other in regards to the audit obligations. So what's required is anything over $500,000 does require an audited financial statement by an independent CPA firm that actually is in this area of this industry. From $300,000 to $500,000, it is a reviewed financial statement, and $150,000 to $300,000 is required a compiled financial statement. Then anything under $150,000 is only required a cash disbursement, cash receipts report. Now, one thing I want to make sure everybody is clear on, some associations that hire professional management companies and they're getting a monthly financial statement. Most of those monthly financial statements are accrual-based accounting. They're not cash-based. So I had an interesting situation. Someone turned them into the state. Their income was $90,000. They used the professional management company's report, and the state came in and said, that's accrual-based accounting. That's not a cash disbursement, cash receipts report. So they actually had to go out and hire an independent firm to do that report. Now, a management company could do that because it's not required by a CPA firm. What has to happen is that monthly report would have to be converted to a cash basis. There would be no receivables. There would be no loans on the books. It would be strictly cash. So I do make sure I stress that because a lot of people think they can use that monthly report from the management company, and most of them are not cash basis, they're accrual. The compiled financial statement can be used by the professional management company. You could use the report. However, you need to make sure that it is a true compiled financial statement, that it has footnotes, it has full disclosures regarding all of the balance sheet and income statement. So it's not required in the statutes. It does not say the compiled financial statement has to be done by a CPA firm. I was actually sitting with DPBR last January. We go down there in January and talk to them on different levels of financial reporting, and they had specifically stated the compiled financial statement does not have to be done by a CPA firm. The review and the audit specifically do, because there's actually an opinion on the audit. It cannot be done by the management company. Also, one of the things that comes up all the time in audit obligations is, what is income? So I'll have board members come to me and say, well, our maintenance fees are $400,000, but we passed a special assessment for $200,000, but that's not income because it's a special assessment. It's all income. It's reserves, special assessments, other income, laundry income, rental income, parking income. All of your income is what qualifies what level of reporting you're required to do. So make sure that you're not just looking at your maintenance fees, you're including reserves, you're including in special assessments. So that's very important when you're doing that. Also, the statute allows you to lower the level of service. So let's say your income's $550,000. You're with a professional management company and you say, we've done an audit every year. We want to do a lower level of service. The statute does allow you to waive the audit and do a lower level of service, but it is a membership vote. It does require the membership to lower that set level of service. Now, you do have to do one report. I've had boards come to me and say, we're going to do nothing this year. You're required to do something. So if you lower the audit to a review, or review to a compilation, or a compilation to a cash disbursement cash receipts report, you must provide one of those reports to the membership. It is required. So make sure that you are getting the right membership vote also. I've had boards come to us and say, well, we got the board vote before year end. Well, it's not a board's decision. It is a membership. You can increase. So if you're required to do a compilation, the board can move it up to a review or an audit. The membership doesn't have to do that. You can increase the level of service at a board level, not a membership vote. You want to talk about, from the tax perspective, some voting that is required for
Yes.
their reports?
We were just contacted by a housing cooperative, and they're taxed a little bit differently. Most of the associations and the condominiums have the opportunity to file under 528, which doesn't tax any situation where your operating revenue exceeds your expenses. Not so in a housing cooperative. So if you collected more maintenance revenues than what your operating expenses were, you would be subject to tax. So there's two opportunities that a housing co-op can do to take advantage of potentially, not being subject to the tax. And the first is this revenue ruling 70-604. That allows the money to be returned to the shareholders, or alternatively, go to reduce next year's budget. And so Nicole will tell you, as she goes through her audit side, that she needs to see that that budget next year, in effect, has been lowered by the amount of the overage that was collected in the prior year. And more importantly, there are two other pieces that need to take place. One, the shareholders need to take a vote to either refund and or roll it over against next year's, and it has to be done prior to year end. So you can't get into January and say, if you're a calendar year, oh, we collected more than what we spent, and now we're going to have this vote. It doesn't work that way. So that's important. And probably the other thing for the associations and the condominiums is that the timing of the audit and when the information becomes available. If you're filing a 1120H as an association or condominium, you're allowed to forego any quarterly estimated payments on any tax due. The tax is due with the return, which for a calendar year filer is going to be 4/15. So that means that if you think that you're going to be subject to tax, A, you should put it into your budget for taxes when you're doing it in the fall, and B, make sure that you know what it is so that you can fund it by the due date of the return.
Okay.
Otherwise, you're going to be subject to a failure to file penalty and a failure to pay penalty. And so that, and along with interest. And so you want to kind of circumvent that. And it's also good and best practice to reach out to your firm that does the audit and the tax work so that you could work up a reasonable estimate of the expenses that might go to offset that and potentially eliminate the tax. But it's something that you should be aware of not only when you get to budget time, but as you get into the first quarter of the year.
Yeah, because in 2019, we saw a lot of associations actually paying tax. A lot of them made really good interest in 2019. This year, it's probably going to be a little different when we go to file taxes next year. So we don't think they're going to be in much of a situation like they were in 2019. So it is something you want to reach out to and also find out what tax return you are filing. So if you are required to do that membership vote before year end, if you're filing the 1120 or the 1120H or the 1120C, which is cooperative,
Right.
And educate yourselves on what you're filing.
Bill, Nicole, I do have a quick question that came in.
Sure.
So you'd mentioned that, sometimes you don't want to be submitting information based off of accrual. The state might kind of send that back. What about residents that request everything in accrual? Is that something that you have to provide?
Great question. So under statutes, it says year-end financial reporting. So if everything is based on their income, so let's say an association is $300,000 in income level, they're going to be required to do a reviewed financial, which is accrual-based accounting. Every report at year-end is an accrual-based accounting except cash disbursements, cash receipts. And that would be only an association that has $150,000 or less in income. And I have to say, I'm surprised the statute hasn't eliminated that because that report is not very informative. You don't have receivables on there. You don't have your loans. So it's basically a cash basis. So it's not a true picture of the association's financial position. So I would always recommend, even if you're doing the cash disbursement, cash receipts, is to have an accrual-based report because that gives more information to the owner and to banks. If you're going out to get financing, banks aren't going to want to see cash basis. They're going to want to see accrual-based accounting. So it is more informative to the owner.
Right. If you were a reader of the financials, you wouldn't necessarily know that there were 10 unit owners that didn't pay their assessments, whether they were quarterly or monthly. And so that's the pitfalls of having on a cash basis.
Correct.
Mm-hmm. Okay, and I've got one more. We received a $150,000 bonus from a contractor that has not been in the budget. Can we add the $150,000 to our reserves, or do we have to have a member vote?
So I'm trying to pull up the questions. So he's asking, he received $150,000 bonus from contractor?
Yeah, you should see it in the Q&A section under answered. And Stefan, if you could provide a little bit more detail, we could come back and circle around.
Yeah, when he's saying he received $150,000 from a contractor. The association received $150,000 from the contractor? Is that what he's asking?
It appears so. We'll see if he could give us a little bit more detail.
Yeah, I'd like to know.
We'll circle back.
It's unusual where the contractor's paying the association.
We got a new ISP.
Internet service provider.
Oh,
so
okay.
That's a
cable door fee. Okay.
Right.
So he's asking, can you repeat the question?
We received $150,000 bonus from it seems like an ISP that has not been in our budget. Can we add the $150,000 to our reserves, or do we have to do a member vote?
Okay, so that's a great question. So from the financial statement side, when they receive that cash, they can decide wherever they want to put that. They can put it into their operating budget. They can move it into reserve, which a lot of people do. But from a financial standpoint, it gets amortized over the life of the contract for tax purposes. So I'll let Bill explain the tax side, but on the financial side, cash-wise, they can move it wherever they choose as a board, where they choose to put that in.
Yeah, typically what happens is when associations sign up for a new cable service provider, it's usually at least a 7 to 10 year period. And so the cable company, as an inducement for them to sign up, provides the associations with a door fee, if you will. And so the door fee is usually a lump sum amount. It's paid at the start of the contract. And so what typically happens is from a GAAP perspective, they look at the terms of the contract, and the actual income is earned over the life of the contract and taken into revenue at that point in time. And so from a tax perspective, we're allowed by Treasury regulations to follow that book treatment, even though the cash is received up front, to recognize that cash is subject to tax over the period of the contract. And so therefore we can ascribe expenses against it and not pay tax that you would otherwise do in the situation where it was received and booked as a lump sum.
Correct.
Wow, that's a great answer. Thank you. I've got another here. This seems like it might work for both Scott and Nicole and Bill. Can an HOA who has a website, can they take money from ads on that website, from real estate brokers, security companies, etc.? Yeah. Mm-hmm. So I'll let you take that.
Well, whether or not they can and whether or not they should probably have different answers.
Exactly.
I think the technical answer is yes, they can. There could be tax implications because that sounds like advertising income. Whether or not they should is a different issue, and I would advise against it. The association is a not-for-profit corporation. You're supposed to assess your owners as closely equal to your expenses as possible. You're not in the business of raising revenue from collateral sources like that, because first of all, it could be ripe potentially for what I was discussing before, the business judgment rule and fiduciary obligations of members in terms of perhaps giving a favor to someone to advertise on a website that could cause a member to derive a certain benefit, which cause a conflict of interest, which would have to be brought before the membership by the board of directors. So there's a fair number of complications if you're going down that road. That's best to probably avoid if at all possible.
Yeah, on the tax side, that is revenue that is subject to tax should they decide to do that. And typically what they'll do is they'll raise revenue enough to offset the expenses of a newsletter or whatever publication that the association potentially has to offset it to zero.
Great.
Okay. I saw a few questions in the Q&A that seemed to pertain to the issues that I was raising before. So maybe I'll just jump back into that. Nicole and Bill, then you guys could hit the preparation of budget category. So a few things that I actually neglected to mention in my race to get through my topic, because I wanted to get to Nicole and Bill as quickly as I could, is as it relates to taking votes. When a board of directors takes a vote, like I've repeated perhaps ad nauseum, that has to be done at a board of directors meeting. What you do see oftentimes are members emailing each other and making some decisions on things that are pretty darn important by way of email. That is a no-no. We don't want to do that because, again, like I said before, the membership is supposed to be entitled to the benefit of seeing your deliberations and ultimately your decision. And if you're making these decisions behind the scenes via email, then you're depriving your membership of that deliberative process to which they're entitled to witness. Now, having said that, there are certain limited exceptions to the voting by email prohibition. If something is so minor in nature, and this is the example I always kind of default to, if your property manager is sending an email around to the board asking if it's okay if your pool cleaner comes on a Wednesday instead of a Tuesday, you know what, that's probably fine for the board to chime in and say, not a big issue there. Sure, that's okay to do it on a Wednesday instead of a Tuesday. But anything that's substantive in nature, I know that's kind of a vague term, anything of any real meaning to the association from a financial perspective, a contract, the manner in which the association is really going to be maintained in a big way, that cannot be decided and should not be decided through email exchanges among board members. So try and avoid that at all possible. And at board meetings themselves, a member does have the right, to the chagrin of most board members, to videotape and audio tape meetings. It's not pleasant, perhaps uncomfortable to know that you're being taped in that fashion, but the membership does have the right to do so. The board and the association has the right to adopt reasonable rules as it relates to videotaping and audio taping. I've drafted many of these, and good policies are a requirement that a member notify the board, the association, the property manager at least 24 hours in advance of deciding to audio tape or videotape. So everyone kind of has a heads up and you're not ambushed at a board of directors meeting. Also, if there's going to be a videotape, there can't be any obstructive lighting shining in people's faces or any type of beeping going on. That could be and should be prohibited. But be aware that there's a general right on behalf of a member to videotape and audio tape with certain reasonable restrictions as enacted by the board. Speaking of the board, this comes up a lot. What happens if someone resigns? What do we do with that position? Some people have had enough of their very highly paid position on the board of directors and move on to greener pastures. So when there is a vacancy, it is based upon how your governing documents read. Most documents will say that the board of directors may fill the vacancy as they see fit, meaning, let's say a board member resigns halfway through their one-year term. It is up to the remaining members of the board, not the membership, remaining members of the board to appoint the person that they desire to fill that spot for the remaining 6 months. This is where sometimes this issue turns on one word in your declaration, on your governing documents. If the governing documents say that upon a vacancy occurring as a result of resignation, disability, death, etc., the board say shall fill the vacancy. Well, shall is a mandatory term, meaning that the board has to fill the vacancy, and they're supposed to do it within a reasonable period of time. Sometimes the governing documents say may fill the vacancy. Guess what? That gives discretion and some latitude to the board to fill the spot or not fill the spot. If the board says, you know what, we don't want to really fill the spot, we'll just let the next election come and the membership will vote as to who they see fit to fill that spot, then the board will have the right to do so. But again, it turns on these words, may or shall, and that's why attorneys kind of need to dig into your governing documents, find the relevant provision, and find the particular word here or there.
Scott, I've got one quick question while we're on the topic of board responsibilities and duties, and this kind of relates back to that president. Can the president limit which director can contact the HOA lawyer or attorney?
Yes. It doesn't come down to the president making that decision. It should be a board decision, which is proper for the board to take a vote and say, this is the liaison between the board and the attorney. And while I am happy to field questions from various members of boards of directors, and I do that often, and more times than not, it's not disruptive. But if you have multiple members of the board contacting the lawyer or the accountant, CPA for that matter, it could become obtrusive, it could become overwhelming, and it could increase attorney's fees and costs to the association, and that's not advisable. So while it's not the president's decision alone to dictate who has the right to contact the board, typically it is the president that is that person that interfaces with the association attorney. It's probably proper to have it done that way, but it's good to have a board decision, vote, resolution, just assigning a certain person that responsibility as the liaison with counsel.
One other, since we're on the attorney topic, would our HOA attorney charge us by the hour, or is an annual fee or retainer that the HOA would be charged?
Well, that depends.
And maybe that could be taken up offline. Yeah.
Attorney answer.
Famous words that I utter quite a bit. It depends.
Yeah.
But it does depend on the number of communications, the nature of the community. Some communities have 10 units and other communities have 1,000. So the monetary relationship between the attorney and the community could differ from community to community. And I have different working financial arrangements with the different communities that I have, depending upon their needs. So we could talk about that separately if you'd like to.
Okay, yeah, we'll make sure that you get in touch with that individual. And I do have one other.
Sure.
This goes back to meeting minutes. When it comes to committee meetings, are there similar rules for meeting minutes as the board meetings?
For committee meeting minutes, good question.
Minutes, yes.
Yeah, for committees, it's very different. Committees are an informal gathering of folks that are, bless their heart, volunteering their time to help out the association with a particular issue. And the committee procedure is not the same for board of directors meetings, with one exception. If a committee is authorized and given specific authority by the board of directors to make final decisions as it relates to certain issues within the community, most particularly like the ARC committee, the Architectural Review Committee, oftentimes makes the decision to approve or disapprove of the painting of a house, or approve or disapprove the putting up of a certain type of fence. That is a final decision in most cases, and that is a committee meeting that must be noticed to the membership, just like traditional board of directors meeting, 48 hours notice, and meeting minutes must be taken. But other types of committees, such as the social committee, for example, or even a budget committee that's making recommendations to the board, you don't need meeting minutes. In fact, it's not advisable to have meeting minutes. There's no reason to have any, nor do you have to notice those informal meetings to the membership.
Perfect.
Talking about
Okay,
meeting
thank you very
minutes,
much.
that's also a subset of business records, as I mentioned before. And this comes up quite a bit more frequently these days, where it's very, very important. This is more of a property management function than a board of directors issue. But sometimes boards get involved in this. If there is a request to inspect the business records of the community or official records of the community, that must be dealt with statutorily, both in the HOA and the condo context, within 10 business days of the receipt of that request. Failure to do so will result in statutory penalties. If you exceed the 10 business day deadline, statutory penalties of $50 per day up to a maximum of $500. All right, $500 doesn't seem like the end of the world, but it could also turn into a lawsuit. And there are lawsuits going on right now that I am familiar with, where there has been an allegation of the failure to turn over business records timely. In that lawsuit, okay, what's the extent of the association's liability statutorily? $500 plus the members' attorney's fees. So let's say we have a violation of the statute. The association could be liable for the $500 plus if a lawsuit is filed and the attorney for the member who sued over the violation of the statute has $50,000 in attorney's fees as a result of 2 years worth of litigation. That could be the liability that the association is facing for an innocent error in terms of not turning over business records timely. Now, there are a lot of nuances to how the request has to be made to make it a compliant request. The association is not obligated to just turn over documents. The technical procedure is an inspection of the documents. Inspection means that the property manager on behalf of the association is supposed to take the records that are specifically requested with some particularity in the request and make them available for review. That means turn them over by putting them into a conference room and inviting the member to come by and take a look at. And then the member can decide if they want like copies of which they're entitled to 25 free pages of copies. Anything beyond that, it's 20 cents a page. So those little details your property manager and your attorney will be familiar with, but the point of this is if you as a board member, and sometimes you receive these notices, get these requests for copies of records or inspections of business records, don't ignore it, because there could be significant statutory liabilities and attorney's fees that can flow from the failure to properly respond.
And I've got one quick question there. One, what about digital storage of these documents? If they are online, they're accessible. That's something that Vinteum offers. Their meeting minutes are automatically posted. Does that kind of fulfill that statutory requirement?
Absolutely. And,
okay.
And to follow up with that, if those documents are turned over electronically, just email the member PDF copies of those documents stored by Jonathan's company, that constitutes compliance and you avoid any statutory violations. And it's, obviously that's the way of doing things these days. And it's certainly better than keeping boxes and boxes in a storage facility.
Absolutely. And I've got another request that came in. Does the request to review documents have to be done with certified mail or email, in-person, phone call?
The request itself need not be delivered by certified mail, but it does have to be mailed. And that's a very important question. An email request, an email demand, because these things typically come in not nice tones, and an email demand, that does not constitute a proper business record, official record inspection request. I'm not saying it should be ignored, but there are a variety of arbitration decisions and cases throughout the state of Florida that have made it crystal clear that email demands of this sort are not a proper request, and failure to make documents available for inspection as a result of an email demand means that there is no violation because there technically has been no official records request. What I would do in that circumstance is respond to the homeowner saying, thank you for sending that very nice email, but please send a compliant request by regular mail pursuant to Florida statutes. And they could send it by regular mail, or they could physically walk it in and drop it off. And if that occurs, it should be stamped as received on a certain date. So we have a specific date when the request was actually received by the association, starting that 10 business day clock. There's so much to get through, and so let me try and move on here and I'm going to kick it back to Nicole and Bill about budget preparation. And before I officially turn it over, I want to just note that when I was talking about the various notices that have to go out to a community, another one of those exceptions to the 48-hour rule, posting a conspicuous location, are budget meetings. HOAs or condos, you have to notice the community at least 14 days in advance of that scheduled budget meeting. And you must include, as part of that notice, a copy of the proposed budget that is being considered by the board. Sometimes I see funny notices saying, this is the budget adopted by the board. No, it has not been adopted until the meeting occurs and the board makes an official decision to adopt the budget. While it might be a rubber stamp of the particular budget, make sure the notice reflects the fact that it's consideration of the proposed budget and it's sent out 14 days in advance. So with that, I'll turn it back over to Nicole and Bill.
A great point. So just a few things regarding the budget that you wanted to make sure you're aware of, especially a lot of you are probably in budget season. Actually, this year was very interesting. Most of our boards started very early this year. I was getting calls in June and July starting their budgets because of COVID. A lot of them are coming back to us and saying, which I don't recommend, we really need to look at our budgets and saying, should we keep our dues the same? Should we be reducing the dues because we don't know where the next 12 or 18 months are going? So what I've told my boards is really keep continuing it to run it like a business. I wouldn't recommend reducing those fees. You want to be looking at it from a perspective that, yes, you need to look at everybody in the community, but you need to run it like a business. And a lot of them were asking questions like, should we be putting a line item in for COVID? And one of the things I really consulted this year on was, and I've been saying it for the last couple of years, I wouldn't put a line item called COVID. I'd be putting in contingency and putting in a line item that reflects anything that is out of the ordinary that is coming up. And in the past couple of years, I've advised over and over in budgets that contingency line item should be increasing and should have a significant amount in there for things that are going to come up that are unexpected, especially if you are waiving reserves. If you are not funding those reserves by the membership, that contingency line item should be even higher because you're not going to have those backup funds for capital items that are going to come up. So a lot of the deficiencies I see, and that's required under statutes, is the first thing is the name of the association needs to be on the budget. You would be very surprised how many times I get a budget to do the audit and the name of the association is not on the budget. Very important. Also, the dates of the budget, showing that it goes from January 1st, 2020 through December 31st, 2020. Make sure those dates are on there. So anybody looking at it, they know what this budget, when it's running from. If you have a different fiscal year end, then you would put it at that also. Also making sure that the budget balances. So a lot of time, and I know it sounds crazy when I say that, but I've come in and seen budgets where there's a surplus, where they have money left over. So that is not allowed on a budget. A budget is to be balanced. So if you should always be starting with your expenses. You should always be looking at the expenses versus saying, what do I want my maintenance fees to be? It's like when you go in, I always use this as a correlation. When you go in to buy a car, You don't go into the car dealership and say, I want to be at $200 a month. That's not something you go in and say to the dealership. It's the same thing with budget. You shouldn't be saying, I want to pay $200 a month and work backwards. You really need to look at every expense line item and say, where are we at? I love the fact when associations send out a letter to all of their vendors and say, are you going to have an increase this year? Let them come back, especially your contractors, and say, yes, we're going to have a 1% increase, or we're going to keep our fees the same. Now you have a good number in those contract line items for things that are known expenses. The hardest part in a budget is the unknown, the repairs and maintenance, the contingency line item, things that are unexpected. I'm surprised too when I see a lot of times we do a budget versus actual, and on the cable line item, there's a variance. You have a contract. It tells you every year what it's increasing. You should be able to look at that and know what next year's fees are going to be. They're the kind of line items that are very easy to budget for. The next area that is one of the most, I think, difficult, and that I see a lot of errors in budget, is the reserve side. The state of Florida DPBR, I talk to them a lot, and they say that is the #1 area that they get written up, that people turn them in for. First thing is HOA and condo, very different. So let's talk about condo side. Condo has statutory reserves required by 718. You must put a budget out fully funding reserves. And if you choose as a board to say, we don't want to fully fund, then it goes to the membership to decide if you're going to partially fund or waive the reserves. So it's always a membership vote. But the budget must include the reserve schedule with the fully funding. I see so many discrepancies where people say, well, we waive the reserve so we don't have to show the schedule. So I tell them, well, what are those people waiving? If they don't see a schedule, they don't know what they're waiving. All they're looking at is the dues and saying, well, the dues are lower, so that's why I'm waiving it. So it is a requirement under 718. 720 is very tricky. So I always say to my boards, talk to your attorneys. Did the developer establish them? Did the membership vote on them? So always have your attorneys let you know if you're statutory or non-statutory. Only your attorneys can tell you that. Your accounting firm cannot tell you that. We always ask, if a board tells us we're not sure if it's a new client, we always say call your attorney, because there are requirements under HOA. But if you are statutory under your HOA, it's the same thing as condo. You must put out the reserve schedule with the budget. You must show fully funding. And then if you choose not to fully fund, it would be the membership to vote that. If they're non-statutory, they're really board reserves. They're basically like a savings account. The board can choose how they spend it. They don't have to get a membership vote to fund it however they choose. They can have a general reserve. Most of my HOAs are non-statutory. Most of them fall under that. They don't really have the statutory requirement. Also, make sure that that disclosure on the budget is there if you have statutory reserves. That if you are not fully funding those reserves, that there is a potential for a special assessment. There is a specific, and you can ask Scott for it, anybody to reach out to him. There's a specific verbiage that has to go on the budget in regards to those reserves. And I see so many associations that fail to put that on the budget, and it is a requirement. And you want to make sure too, as a board, you're protecting yourselves, that you're disclosing. Because if people are choosing to partially or waive those reserves, there's always going to be a potential for a special assessment, because you're not going to have those funds out there when those projects come due. So it's very important. And also making sure, my last comment is the reserves. Is the reserves being calculated correctly? So why I say that is, some associations have the component method, straight line method. They have a line item for each reserve. They fund it based on the schedule, how many years are remaining, what is the estimated replacement cost, and that gives you your calculation for that line item for that year of funding. Very easy calculation. The other method is called the pooling method of reserves. It is a much more complicated calculation. You must take the longest life of your longest asset in that reserve. So let's say you have concrete restoration in your reserves. That goes out 50 years. The schedule must go out 50 years, the longest life of the asset. Then what happens is you must go in and fill in those expenses when they're coming due. Where I see the problem is, let's say painting. Every 7 years you need to do painting. So someone will put in their schedule, 7th year painting, and then they don't put it again. Well, painting is every 7 years. So if your schedule's going out 50 years, every 7 years, you must put in the painting expense. It's required. That is how you do a true pooling schedule. And what happens is every year you must reevaluate that schedule because that funding will change. You can't have a balloon payment, but you can reevaluate it every year. Those costs changed and your funding changed. That's allowed. A balloon payment's not allowed, but reevaluating the reserves every year is a requirement. And you should do it either by a reserve study or going out and getting bids from the vendors to tell you what the cost is going to be. Statute doesn't require a reserve study anymore, but I always say every 3 to 5 years, I would have one done. I wouldn't be relying on going out and getting bids and putting it on the burden on the board members. Having a reserve study, a professional comes out, evaluates it, they give you a schedule, and then the liability goes off of the board because they're saying, I've relied on the professional, I'm using their advice, and use that for the reserve schedule.
You know, some of the things that we're hearing from the associations now as they prepare their budgets is from their insurance brokers. And with the wildfires, the storms that we've had, the destruction in the city, there's basically only 5 to 6 worldwide, reinsurance providers. And what they've been saying is, generally speaking, that they anticipate that the premiums would be a minimum of an 18 to possibly 34 or 40% increase. And one of the things that Nicole was talking about is, what do you do in that regard with respect to what your budget is? And she had some possible best practices for the boards to consider with respect to potentially lowering the premiums by lowering the coverage, but putting the balance of that into a contingency reserve.
Always into contingency, absolutely.
And in the event that you needed to spend it, you had it. And so that's, when we say 18 to 34%, that's a pretty significant increase. And so it's something that the boards might want to seriously consider as they move forward in the budget process.
I agree. And some associations have gone out and tried to have lines of credit. So they have that open that if something does happen for that deductible, they have a backup. We're just noticing that a lot of banks are now holding back this year with COVID on those lines of credit if they're not used for something specific.
Let me add to that, Nicole, in terms of the difference, pros and cons of having your reserves be pooled versus the straight line component method. What pooled means is that you have one account essentially and one lump sum amount that is there for the association, for the board to use as they see fit for any of the various components which are subject to the reserves. Correct. As opposed to the straight line where you have kind of silos, for lack of a better word, of different issues, whether it's roof or roads or painting, where you could only take monies from those various silos for the particular project that it applies to. Pooled is different. If you have all the money commingled together in terms of the reserves and you have a particular project involving the roads that exceeds what you thought it was going to cost, you could take as much money as you want out of the pooled account. That's good and bad. I mean, it's good because it gives the board quite a bit of flexibility where you're not locked into what is set aside for the road silo of reserves. You could take from the entire pool. However, if you deplete the entire pool for purposes of the road project, you're not going to have money left over to paint or replace a roof in a clubhouse. So you have to be careful about it and be careful about taking on that flexibility and making sure the board is responsible with the amount of reserves that are pulled from the pooled account. And changing from straight line / component to a pooled reserve method does require a membership vote on 14 days notice. It's not for the board just to decide on their own. So there's a procedure that you need to follow as it relates to that. You have to have a quorum of the membership, and typically, unless your governing documents say otherwise, you have to have 51% of those persons, those members, present in person or by proxy, if they filled out a form saying it's okay to go to the pooled method, and that counts as a valid vote. But don't think that you guys as a board could just decide, yeah, we're going to go pool this year. You can't flip back and forth unless you get the requisite membership vote.
Absolutely. Very good point.
And I've got a question to piggyback on that. The question is, our community assessed us for a gym building that did not get built and a pool renovation. No budget was set. Much of the money was spent to renovate the pool, leaving not enough money to build the gym building. What happens to the remaining monies that was collected?
Was this a special assessment? Is that what?
It seems like that. Yes.
Okay. Leftover special assessment monies are supposed to either be returned to the membership, which is probably the more rarely used option, or can be used to reduce the regular assessments in the following year. It's one or the other. It's not just pushed into a special kitty for the board to dip into as they see fit. So, you could return the surplus special assessment monies pro rata to the members, or that surplus has to be used to reduce the regular assessments for next year's budget, one or the other.
And I had another question along the same lines, $12,000 settlement from a failed construction project. Same sort of thing, or would those be allocated differently?
That's not to be returned to the membership. That probably goes right into the operating account. I assume, Nicole, that's acceptable.
I agree. That's how I would definitely respond.
Thanks for clarifying. Okay.
All right, let me move on to rules and regulations. This is a hot topic among boards of directors, because boards want to be able to make it easy to do things that they see as in the best interest of the association, and to have enforceable rules that the membership will be obligated to follow. Let's break it up into two categories of things. You have your governing documents, which typically, for a condominium, it's declaration of condominium. And the governing documents also encompasses your bylaws. Your bylaws are a separate set of documents which typically are just procedural aspects of how the association's business is to run, for notices of meetings, the board is to be configured, whether vacancies are to be filled on a mandatory basis or not. Those types of strictures are set forth in your bylaws, which are oftentimes an exhibit to your declaration. You also have articles of incorporation, which are your birth certificate of your association. And that's oftentimes an exhibit to your declaration. So HOAs have a declaration as well. They come in different names and phrases: declaration of covenants, restrictions, and easements, something along those lines. Again, you'll have bylaws and articles of incorporation. Those amount to your governing documents, capital G, capital D. These are defined terms under the HOA statute, chapter 720, and the condo statute, 718, and co-op is 719. Then you have rules and regulations, which are different, which are separate and distinct. Rules and regulations are supposed to be enacted to supplement what exists in your governing documents. They're not there to replace or modify a provision in your declaration. In fact, it's not permissible to do it that way. It would be, the rule would be invalid. The declaration really is the constitution of your community, and the language in your declaration has the highest degree of validity and enforceability, unless it abrogates some constitutional right or is completely arbitrary and capricious on its face. For another way to say it, if the provision in the declaration is so ridiculous sounding, then it won't be enforceable. But otherwise, it will be enforced as written. The only way to change that is to do a formal amendment to your governing documents, to your declaration, which necessitates a membership-wide vote, depending upon the percentages set forth in your declaration. Oftentimes, there's a provision in your declaration that says amendments, and will say, usually for HOAs and for condos, you need 2/3 percentage of your membership to adopt an amendment to the declaration. Sometimes it's lower, 50%, sometimes as high as 80%. It can't go less than 50 and it can't go higher than 80. And usually it's in the middle at 2/3 or 3/4. But you have to go through that formal process of, and my recommendation is, if the board would like to see various changes to their documents, because you have an antiquated set of governing documents that need to be updated, which documents need to be updated from time to time with the evolving nature of laws and strategies in terms of a community association. You need 14 days notice to do so, and the best way to kind of get it in place is for your attorney to meet with the board and do a bullet point list of kind of a wish list. What does the board want to see now embedded in your governing documents? And that's adopted at a board of directors meeting, this bullet point wish list. And then it gets kicked back to the attorney for purposes of drawing up the proposed amendment. Do not try to draft a proposed amendment. It's not advisable, and it's the unauthorized practice of law, which is a no-no. The attorney draws up the proposed amendment, and then that is then sent out to the community at an established membership meeting with at least 14 days notice, and having sent out the proposed amendment as well. And that's where that vote is tallied. Best practice involves collecting as many votes as possible in advance. It's hard to get, oftentimes, to have the membership participate in anything in your community, let alone 2/3 of 75% in order to meet the requisite voting percentage. So what most communities do is they send out well in advance limited proxy forms asking for folks to vote yes to adopt the proposed amendment, and collect those in advance. You can collect them by email, by fax, door to door, although I don't know who's going door to door these days, and then pile up as many of these limited proxies as you possibly can up until the day of the meeting. And maybe you'll have some stragglers come in and turn in a few of their ballots or limited proxies at that point. And if you have the right percentage, terrific, then you adopt it right there. What happens if you fall just short, which happens a lot? Say you get 55% of the membership to vote in favor of the amendment, and you need 2/3. The practice tip is to have your attorney with your property manager, prior to the meeting actually going forward, adjourn the meeting. Don't have the meeting take place, because the limited proxies that were turned in are valid for 90 days. So you reschedule the meeting, kick it down the road in another 30 days, go and acquire some more of the limited proxies that you need, and then hopefully at the next scheduled meeting, you'll have the limited proxies that are still valid from the first meeting and the newly collected limited proxies, and you'll have enough perhaps to have the amendment pass. Once it is passed, then it needs to be sent out to the membership. This is missed quite a bit, where if an amendment is adopted, it must be sent out to the membership, of course recorded in the public records as well. So there's some niceties here, some procedural requirements to tidy things up at the tail end after an amendment is adopted. Another thing as it relates to rules, as of July 1st, 2018, this is not a widely known statute, but it needs to be. If an association amends any rules and regulations affecting parcel usage, I used that term before. What is parcel usage again? How you go about submitting an application to paint your house. How about different types of rental criteria to approve or disapprove of a tenant? That's parcel usage. If there's an amendment to your rules post July 1st, 2018, those amended rules have to be recorded in the public records. If they are not, they are unenforceable. So make sure you have your attorney oversee that process. If necessary, and usually it's proper, to draw up the proposed rule, have it adopted at a duly scheduled board of directors meeting, at least 14 days notice. If it passes, it goes back to the attorney to prepare a certificate to record that along with the actual rules in the public records to make them usable. We have that.
Scott, I've got a quick
yeah.
question along the lines of the declaration. The community builder used a template for their declaration, and it says that members of the association are registered in Dade County. Well, this community is not in Dade County. Does that mean that no one is legally a member of the association?
Can you read that language again? I didn't really hear it.
Yeah, sure. So the builder of this presumably new community used a template for their declaration. In the declaration, it said that residents are in Dade County, or registered to Dade County. Well, this community is not in Dade County. Does that mean that nobody is legally a member of the association?
No, it's it's an embarrassing typographical error, it sounds like, but I don't believe it would render the entirety of your governing documents and your declaration in this particular hypothetical invalid. So no, and that's another reason, another example rather, of how you need to clean up your governing documents every few years, particularly post turnover. If you're, say, 8 years since your developer had control of the community, your governing documents oftentimes have a multitude of references to the developer in the declaration, which are no longer applicable. You'll have references to the developer's bank and the developer's bank's rights as it relates to control of the community in some form or fashion, no longer applicable. So for that reason alone, it's important to clean up the documents as well, to also take care of these types of little inaccuracies that are floating in the documents at the time the developer created the governing documents. Speaking of governing documents, let me hit an issue that touches homeowners associations, the Marketable Record Title Act. That's a fancy statute that deals with the invalidity, like you were talking about, Jonathan, of governing documents after 30 years. Now this is a very simplified a summary of the Marketable Record Title Act, and it's not exactly 30 years. It depends upon the particular title history of each individual unit, but by and large, we call it the 30-year rule, where if a set of governing documents is 30 years old, it expires under the Marketable Record Title Act unless preserved, it's called, unless there is a notice of preservation, which is a simple 2-page document adopted by the board of directors prior to this 30-year mark and recorded in the public record that springs new life, another 30-year term for these governing documents if this notice of preservation is filed prior to its 30-year expiration. What happens if you miss it, the 30-year notice of preservation obligation? Then your documents could be deemed expired. What does that mean? Well, that means the association does not have the ability to collect assessments, potentially. That's a problem, right? The association would not have the ability to do much of any covenant enforcement. I'm sure your board and the association would be too pleased to hear that. So it's Armageddon, I think, is probably a fair word in terms of your governing documents going invalid and expired. It creates a lack of any framework to give the association the ability and the board to do anything in terms of enforcing restrictions, collecting assessments. So it is critical that this Marketable Record Title Act date not be missed. And if it is missed, then it's a procedure to spring life back into these documents called the revitalization procedure. Much more involved, much more expensive than the simple 2-page notice of preservation, which could be adopted by the board alone. Revitalization requires 51% of the community to agree to revitalize your governing documents. And there's a series of forms that have to be sent out, and ultimately it has to be approved by Florida's Department of Economic Opportunity in Tallahassee. So it's a big deal. I've gone through these processes in the past, and revitalization can happen and can be done. It's expensive. The better path is just to make sure we don't skip past our 30-year Marketable Record Title Act mark and get in a notice of preservation well in advance.
I do have another question while we're on amendments and making amendments. This question is, if the board decides they made a wrong decision on a previously adjusted amendment, it's recorded, and if they determine that it's a wrong decision, they want to backstep, are there opportunities for them to do that?
Well, sure, but the way to correct it is to draft up a new amendment. You could always modify what exists in your governing documents, whether that language exists in the form of the initial set of provisions and language, or language that appears in an amendment. Any of that can be changed through a new amendment. But the amendment requires a vote of the membership, not just a stroke of the pen by the board of directors.
Okay, thank you.
I have an interjection.
Yeah, go ahead, Peggy, please.
Many of you may know I was a former vice president of business development for GRS Community Management, and a very good company. One of the things that I used to stress is that we had a transition team. When we took over properties, our transition manager, and I recommend that the audience take a look at the new property management company if you're making changes, to make sure that their transition process includes reviewing the dates of your documents so that they don't expire or they have not expired. This is a very huge feature in dealing with a credible company. I just want to mention that. That is one of the things that GRS does do.
Great. And the good news is if you are part of a board of directors in a condominium association, everything I just said that sounded terrible and scary does not apply to you. Because of very unique nuances in the Marketable Record Title Act. There's no expiration of your governing documents in 99.9% of condominium associations. But homeowner associations, be aware.
And how does this relate to a master board? If they're voting on adopting new rules and regulations, does the entire community need to vote, or what percentage of the community?
Yes, it's the members. It's the first aspect what you said. The entire membership of the association must vote to approve of an amendment to a set of governing documents of a master association. So just like the HOA, a sub-association's membership must vote on a proposed amendment to its governing documents, the membership of a master association, perhaps, are all the sub-associations and all its unit owners contained therein. So it could be a Herculean task to obtain the requisite vote in a master association, but it is necessary. Okay, speaking of the Marketable Record Title Act and the potential to lose the ability to collect assessments, which is dramatic and serious, let's talk about collection procedures in general. With living in a world where your documents have not expired. Here are the 3 stages of collections, I like to call it. When an account goes delinquent, it's really 4 stages, but for an attorney, it's 3 stages. The first stage, and we'll call it 1 and 1A, your property manager is sending out a reminder letter to the individual who has not paid the assessments. If that reminder letter doesn't get the job done, then the account needs to be turned over to the attorney, where step 1 takes place, where a demand letter, it's called a notice of intent to record a lien letter, is sent out. It's not the lien itself, just saying, hey, Mr. or Mrs. Owner, you have not paid your assessments, which amount to X dollars. You now owe that amount plus attorney's fees of X. Usually at this stage, attorney fees are nominal in nature, but still, plus perhaps default interest or late fees. And that is embedded in a fairly straightforward, simple notice of intent to record a lien letter, or I call it a collection demand letter. That goes out, and this is where the time periods change a little bit for HOAs versus condominium associations. For condominium associations, 30 days after that letter goes out, and if the account is still not brought current, the owner has failed to pay what they rightfully owe, then a claim of lien can be recorded against the property, against the unit, done by an attorney, must be done by an attorney. And that claim of lien will reference all the amounts they're due and owing as it relates to this delinquency. For homeowners associations, it's 45 days. So 45 days after that demand letter is sent out, then the association attorney can file and record a claim of lien, a copy of which in both situations, copy of the recorded claim of lien is sent out to the owner as hopefully another firm reminder that, hey, you are late on your payments and now you owe all these monies on top of the missed assessments, please pay. What happens if they still don't pay? 30 days after that, in a condominium, the association has the right to file a foreclosure. Just like a bank files a foreclosure for failure to make a mortgage payment, a condominium association has the right to file, and we call it a lien foreclosure action, where the association has the right to foreclose on the property and take the property away from the unit owner due to failure to pay assessments. Is it a good idea to move it into that stage 3? That's a complicated decision and analysis that all this requires advice and input of your attorney, but particular this stage, because first of all, filing lien foreclosures are more expensive. We're not talking about just a few dollars to send out a demand letter or $100 or $200 to file a lien. You're talking about a few thousands of dollars to file a lawsuit, a lien foreclosure litigation. And plus, it might not always be in the best interest of the association to become the owner of a unit. That will be a function of, is there a mortgage on the property? Is there a mortgage foreclosure that is pending on that property? Because if there is a mortgage foreclosure, there's really no point for the association to file its own foreclosure, because the bank's mortgage foreclosure will supersede and take priority over anything that the association would do. So it would be wasteful for the association in the context, that hypothetical, to file its lien foreclosure. But perhaps if it's just a mortgage and it doesn't appear as if the bank is enforcing its mortgage, there's no mortgage foreclosure, the association could foreclose, become the record owner of the property, and perhaps rent the property. It can't sell it because you still have a mortgage encumbering the property, so that would prevent the transfer of the title of the property because you have a mortgage that still have to be paid off. But that would not preclude the association from renting the property and deriving income and collecting some lost assessments over years of non-payment by an owner. Perhaps there are property taxes that are delinquent as well. That has to be looked into. You don't want to file a lien foreclosure if there's a tax deed sale with the clerk scheduled in 2 weeks. That would also be wasteful on the part of the association.
Hey, Scott,
So, yes.
good question. How does bankruptcy, if anything, affect the filing of a lien by the homeowners association?
Stops you in your tracks, and that does occur where if the association is aggressively, and it's my policy to suggest being the most aggressive you can, that usually bears the most fruit. To follow these statutory procedures like clockwork, and you're going down that road, and if we either filed a lien or we're on a verge of filing a lien foreclosure or have filed one, and we receive notice that the owner has filed bankruptcy, all collection activity, including the litigation, must immediately cease. What should the association do, if anything? File a claim with the bankruptcy court for the outstanding amounts due and owing, and hope that the association could get paid in some form or fashion through the bankruptcy proceeding. Very different if there's a Chapter 7 bankruptcy filing versus a Chapter 13 filing. Chapter 13 is a payment plan, typically over 5 years, where more often than not, the association does get paid back a good portion of the outstanding amounts, although they're subject to something called lien stripping, which is probably too involved to get into for purposes of today's discussion. For Chapter 7, that's a liquidation where there's an attempt to just discharge all debts whatsoever up to the point of the filing of the bankruptcy. So whether it's a 13 or a 7, you may have some component of back assessments wiped out in its entirety, but all assessments that came due after the bankruptcy petition filing are still collectible and chargeable. But until that bankruptcy is concluded, we as an association will be frozen in time, but it's important that claims are filed properly, and other filings at the bankruptcy court, when appropriate, are made by the association's attorney to best protect the association, give us some chance of recovery in the bankruptcy context.
Thank you.
Yep.
Hey, Scott, I've got another question regarding homeowners in default. This question comes from Mary Ellen. We are a HOA subdivision in a larger HOA. Homeowners are in default. We contend that master association needs to do the collections and should not be collecting the money owed to them from our association. Rather, they have to go over homeowners in default. What is your opinion?
Master association is our own. They're entitled to collect assessments through the master association. The sub-association have their own collection rights and procedures, unless there's something very unique written into the governing documents of this community. It's commonplace, and I haven't seen it done any differently ever, where you have a master association and a sub-association. They have different amounts due to those two associations, and those two associations have their own collection procedures and rights and policies, and the sub-association should aggressively pursue assessments due it, which has no impact on the master association collecting what they are rightfully due.
Thank you. Okay.
I also have an interjection, and that is that, I apologize, my voice, I'm losing my voice for some reason, but if you accept payments for past due assessments for one resident, you have to do it for all. You can't be selective. And so enforcing what Scott's recommending as policy, the steps that he's saying to take, or put a credit policy in place that you'll take payments until a default happens, it has to apply to the entire community of residents.
Yeah, the collection of assessments must be uniformly applied.
Yes.
And as it relates to that, at times I have seen where a particular owner, say, is providing a valuable service to the community, whether it's an accounting function or some type of landscaping of some sort. There can't be a barter where the association can say, you know what, Mr. Owner, you're going to do X service for the association. We're not going to charge you assessments for the next 6 months. That is improper. All assessments must be collected uniformly as against all owners, regardless of whatever benefit or service a certain member might be providing. In that context, you could have a separate contract with that owner for whatever service they're going to provide and have the board vote to approve it, but never defer or abate the collection assessments in that type of setting. Now, having said that, if various collection hypotheticals, are presented to boards all day long in terms of the amounts of delinquencies, different circumstances, perhaps some legal issues that come into play, it doesn't necessarily mean that the board is locked into adopting the identical payment plan for each and every owner, because the facts and circumstances as to each can impact how the board decides to craft a particular payment plan for a particular owner, which may differ somewhat from another owner. But that doesn't mean you can't just extinguish assessments for this owner and not for others. You never want to extinguish assessment obligations regardless. What happens if a bank takes over property through a mortgage foreclosure and the bank forecloses? And this is, I'm going to segue into Bill Nicole as to accounting aspects of this. If a bank forecloses on property and which culminates in a certain event, it's not the filing of the case, it's not the motion for summary judgment, it's not the trial, if there is one, sometimes there is, it is something called the certificate of title that gets issued by the clerk of court, which is the single document that says, now the bank owns this particular piece of property in your community. Once that certificate of title is issued by the clerk of court, that triggers a couple things on behalf of the association as involving this bank, who is now a member of your community. And what it does is it triggers a safe harbor payment. Under both the HOA statute and the condo statute, the bank is obligated at that moment when the certificate of title is issued to pay the association, not all the back assessments that are owed, unfortunately, that would be nice, but something called safe harbor, which is equal to the following formula: 1% of the principal balance of the mortgage. So let's say you have a mortgage of $300,000 that got foreclosed on. You got $3,000, or 1 year's worth of assessments in your community. Here's the underlying key language: whichever is less, unfortunately. Boo, right? Which was more. But whichever is less out of those two computations. And out of those two computations, whichever is less, that's what the bank's safe harbor payment obligation is to the association right away. And that oftentimes does not equal the unpaid assessments that are owed on the account from the back owner. So how do we deal with this from an accounting perspective when this safe harbor payment is demanded, and it has to be demanded? We do this on behalf of the communities. It's this calculation that we have to follow. And that money comes in, which is, say it's $1,500, but the back assessments on the account are $5,000. How do we treat that, Nicole or Bill, from an accounting perspective?
No, that's a very good question. And The first thing is hopefully that you as a board have been taking into an account bad debt allowance for the last couple of years, that you've been actually recording an expense for that unit, that you haven't been collecting those maintenance fees. Because if not, you've been overstating your revenues. So most of the time, the collection of that money is actually less than what's due. So you would actually have to do a direct write-off. You would actually have to go in and take the receivable because the bank, as you had stated, is not obligated to pay those back dues. So we would actually write off the remaining balance of the receivable. But what we tell our boards is first talk to their attorney and make sure that you're not going to collect any of that. And if you are, and they advise you, you will not collect it, we directly write it off. And then the recovery of that would be recovery of bad debt. And we would actually record it as income, the offset of that, once we write it off.
And from a tax perspective, that income, we would follow the books, and it wouldn't be subject to tax because it would actually be considered a receipt of earlier maintenance fees that were due. So it wouldn't be subject to tax at all. The difference would be is if the association acquired the unit, that would be a huge difference in the way that we would handle it from a tax perspective.
Now, there is a new, and I'm sure a lot of you have seen it at the year end for 2019, there is a new topic 606. It's called revenue recognition. It's the way revenue is recognized now. It's a whole new accounting standard. So in this situation, in the past, you would take the bad debt expense and say, if we don't think we're going to collect it, we'll put an expense for it. The new accounting standard states you cannot show it as revenue anymore. So for that particular unit, you would actually reduce the maintenance fees on the income side to not show that unit as income. Instead of a bad debt expense, you reduce the income and don't show it. Because if you don't really believe you're going to collect it, you cannot show it as revenue under the new accounting standards. It's a major change to the way things are being presented.
Right. And here's a few nuances to mortgage foreclosure events. What happens if the bank doesn't become the owner of the property? Because sometimes that is the end result of a mortgage foreclosure, where some third party decides, yeah, you know, we're going to, this property seems like a pretty good investment. We're going to bid at the mortgage foreclosure sale, and we're going to bid more than what the bank is owed, and because we feel the property is worth a lot more. And some third party, whether it's a person or a limited liability company, becomes the record owner of the property, not the bank, as a result of the mortgage foreclosure sale process. Things are very different. Safe harbor does not apply in that context. The good news for the association is that that third party owner, usually unwittingly, has inherited the entire back balance that is due on this account. And sometimes these, I'll call them crafty third party investors, are unfamiliar with this aspect of the law, and they purchase these properties, and then they get a nice demand letter from myself saying, well, now you owe $14,000 in the back assessments because you're jointly and severally liable with the prior owner for all unpaid assessments up to the past 5 years. So that's something that has to be looked at in terms of who is actually issued the certificate of title in a mortgage foreclosure sale. Yeah, about 95% of the time it is the bank, but in those rare cases, you'll have a third party for which the association can recover a goodly amount, if not the entire amount of the back assessments. There's also the potential to recover back assessments if there are mortgage sale surplus proceeds. If a third party bids at the mortgage foreclosure sale more than what is owed to the bank, there's a surplus that the clerk is holding. Well, what happens with that surplus? That surplus gets held, and any lien holders, which includes the association almost always, can make claim on those surplus proceeds to help recoup unpaid assessments. That's true with tax deed sales as well. It's a great way, and we've done this dozens of times, to recover a nice chunk of money to pay back the association for unpaid assessments on the account that seems stale and uncollectible, but there's a windfall that comes in from making a claim with the clerk of court as involving either mortgage sale surplus proceeds or tax deed sale surplus proceeds. These are complicated procedures, which when the filings typically come to us as the attorney for the association. Sometimes the property management companies who are adept at sending that our way so we can file the statement of claim and push to recover some of these surplus monies.
And that's why, Scott, we always tell our boards, they need to be reaching out to the attorneys, because we'll come back to them and they'll say, we're just going to write it off. And we say, never, ever do any of that. So you've talked to your attorney, because like you said, if they're taking it off their books and they get a third party, there's not going to show anything that's owed. So we always make sure they reach out to you as the attorney to advise them, should they be keeping it on the books.
Absolutely. And I'm going to make reference to what we talked about earlier about association board member liability. While there's very, very few circumstances where a board member could be held personally liable for their actions on the board, here's one instance where you could. If you take it upon yourself as a board member to become the collection agent for the association, if you decide to go knocking on doors and telling Mr. and Mrs. Owner, hey, you haven't paid your assessments for the past 3 months, you need to pay up now. Well, now you're potentially violating the Federal Fair Debt Collection Practices Act by unduly harassing a debtor, which could give rise to personal liability. So do not take it upon yourself, while you may have the altruistic intentions and the best of goals to make sure the association is flush with revenue to pay their expenses, it is not for you to contact individuals, even politely, whether by email, by phone, or going to someone's home, to remind them to pay their assessments. That is the property management company's job first, and if the reminder letters don't work, it needs to be turned over to the counsel for the association for that purpose. So also associated with that issue, I've heard ideas to post on the bulletin board a list of delinquent owners to shame them into paying the assessments. Do not do that. Bad idea. Violation of the Federal Fair Debt Collection Practices Act. So just steer clear.
Game of Thrones style. We all know how that shaming incident worked out, We only have about 3 minutes left here, and I do have a backlog of a couple different questions. So if you guys are open to kind of like, just firing off a couple answers, that would be great.
We'll call it the potpourri section.
There you go. Okay. So board workshops, do they need meeting minutes?
Well, again, there's no such thing as a board workshop. It's a board meeting. So to the extent that things are discussed, just in a general description in the meeting minutes should be memorialized. So the answer to the question is yes. Again, you don't have to recite every utterance, but a general summary of what is discussed is important.
Okay, thanks. I think this is for Bill. Bill, earlier in the call, you mentioned that you guys have been busy doing a couple PPE loans. How would a HOA apply for a PPE loan?
Well, typically what the associations that have applied have been self-managed. And so they, while some critics say that they're not entitled to participate in it, they do meet the requirement that they have wages within the community itself for the management of that community. And they have, in a lot of cases, been granted a PPP loan through the first round. And typically what happens is that the rules, while they're ever changing as well, as long as 60 to 70% of those funds were spent on the wages for the people that were employed by the community, then that would qualify them for that loan to be forgivable.
Awesome.
And so the initial application for that PPP forgiveness was to occur back in May, but since a lot of businesses hadn't opened up because of the pandemic, like restaurants and other businesses, it's now been extended to use those funds through December 31st. And as a result, the period for the repayment and/or forgiveness application has also been extended. But typically, associations that do have a management company don't necessarily have the same criteria for applying for the PPP loan.
Awesome. Okay. Along the lines of the public shaming that we were talking about earlier, do we have to redact delinquent homeowners in our financials?
Well, no. A delinquency report can and should reference the owners, and those reports are subject to an inspection of business records. That's very different than advertising in an unsolicited manner, the posting of names of delinquent owners. But the records of owners who have not paid assessments, that's subject to inspection and disclosure to the rest of the membership.
Okay.
Jonathan, let me cut you off here because I feel like I have to cover covenant enforcement, which is, you know, such a huge topic, and I'm going to do this in rapid fire succession because I know we're out of time, but folks tend to want to hear about this. Fines for violations of rules are terrific and important and a great tool to curry enforcement by an owner. Just be mindful of the statutory limits of $100 per violation with a maximum of $1,000, with one ginormous exception. If you don't have a fine committee, you cannot fine. You have to have a functioning fine committee. So even if your board is up to date on all covenant enforcement related issues, and a particular member is behaving in a way that is clearly violative of the rules or your governing documents, without a fine committee, you cannot impose a fine. To do so will be a violation of the Federal Fair Debt Collection Practices Act. So be mindful of that. There's a whole set of procedures in terms of how fines are to be imposed. It starts with, and this changed a few years ago, it starts with the board of directors deciding to impose a fine at a board of directors meeting, reflected in meeting minutes. And one of our themes, make sure things are reflected in meeting minutes. And then it goes to a fine committee, which with proper notice to the owner, where at that point, the owner can seek essentially to have the decision of the board overturned by convincing the fine committee that the fine should not be imposed. The fine committee's job is limited to one of two things: uphold the fine or reject the fine, not come up with some middle ground settlement with the owner. Specific notices have to go out, again, 14 days in advance of the fine committee to the owner. So that's important to follow. The fine committee cannot be made up of members of the board of directors or any of their relatives. Have to be independent owners, no renters. You could also suspend privileges within the community in certain circumstances, not just impose a fine, as long as you have a fine committee. You'd also suspend voting rights of a particular owner for not paying their assessments or for violating the rules in other ways. That has to be adopted at the board of directors meeting. Certain fines are lienable in a homeowner association. $1,000 or more in fines can subject an owner to a lien being placed on the property, but not with a condominium association. So important nuance between homeowner associations and condominium associations. As it relates to homeowner associations, if a particular issue is not being followed properly by an owner, you can't just go right to court, except in very rare circumstances. There's a pre-suit statutory mediation process that must be followed first. And if the matter cannot be mediated because the owner won't participate or the matter is not resolved at mediation, then the association can file a lawsuit to enjoin a certain violative behavior. The key defense in these cases, last point on this topic, is selective enforcement. You cannot, as a board, as an association, mandate that a particular owner do something but not require other owners similarly to behave in that manner. So watch out for selective enforcement type decision-making, and that could be a significant defense and impediment to enforcing a restriction in a court. Okay. I think that's as much as I could get through in my short time frame on covenant enforcement.
Well, thank you for that.
Okay.
Yeah, we've got a couple other questions, but we could go ahead and respond to those offline. And yeah, thank you very much, everybody.
Thank you.
Yeah, I'm gonna-
Great class. Good job. Thanks,
Yes.
Scott.
Thanks,
I want to
Nicole.
close the
Bill, Peggy,
meeting
John.
by just saying that Scott's will send out these certificates to your registered email address that you registered on as proof of attending the meeting. And thank you again, Nicole, Bill,
Thanks, Peggy.
and also Scott.
Yep,
Thanks,
absolutely.
everyone, for being
And one quick thing, all of the sponsors, if you could, There is a chat section. So if any of the attendees want to get in touch with you, I'd go ahead and just shoot your name and email and phone number just so they can get in touch with you. And one other thing, I know that there was a lot of talk about virtual meetings and board meetings and notice, that sort of thing. Vinteum is launching a new tool tomorrow for virtual meetings. We've got a webinar coming up tomorrow. I'll go ahead and send a link through the chat there. If you'd like to attend, we would love to have you.
Okay. Thanks, everybody.
Thank you.
Thanks again, everybody. Have a wonderful Tuesday. Again, if you'd like to join the webinar for tomorrow, we will be going through virtual meetings, how to host them. We do use Zoom as our tool, but we kind of supercharge it with meeting minutes, meeting agendas, notices, that sort of stuff. So we'd love to see you. I did send the chat to everybody, and have a wonderful Tuesday and hope to see you tomorrow. Thanks. Have a good one. Bye.